Hi everyone, I'm Florbela Yates and I'm responsible for the investment distribution in MFP and I chair the MFP Investment Committee. Thank you for joining us for the first MFP Outcome Matters in 2023. Before we start with the session, just a few housekeeping points. We applied for continuous professional development points or CPD points. I know that this is important to you, so please watch the full session and add your ID number to the CPD section so we can verify your attendance. Our event platform will remain open until the end of April for you to still view this event and still receive your CPD points. You will receive a separate email from Momentum Sales Academy with your CPD certificate during the month of May 2023. Please post any questions you may have for the speakers in the questions and answers section. We will then make sure they send you an answer to these questions as soon as possible after this event. Now, with the housekeeping out of the way, the year has kicked off with quite a few positives. We are starting to see the global interest rate hiking cycle drawing to a close. This, of course, could benefit the consumer's pocket significantly. China's economy is also reopening post the severe COVID lockdowns, and they are one of our biggest trading partners and should drive the demand for our commodities. Bringing it home, our market hit an all-time high in January, breaking the 80,000 points mark, despite all the negative news around the impact of the Eskom failure. South Africans are nothing if not resilient. There is, however, still uncertainty abound, and Sanisha will unpack this a little later. The best thing to do is to stick to your goals, remain invested, and trust the professionals to navigate the portfolios through all the noise and complexities. Before I hand over to Sanisha, please allow me to briefly update you on the MFP Houseview support. We are on the eve of the 2-year anniversary of the launch of the MFP Houseview solutions, and I would like to share the significant strides we've made in gaining your support. The MFP focused model portfolios crossed the 1 billion assets under management mark, which is a 19% growth between the end of September 2022 to the end of January 2023. This is a major milestone for the Equilibrium business, and I want to applaud Flof and team for this achievement. The Momentum-focused fund-of-fund range crossed the 2 billion AUM mark with an 11% growth rate for the same period. The cash and income solutions continue to grow and are sitting at the 3.1 billion AUM mark with an increase of 3%. On the offshore front, the feeder funds are sitting at 412 million rand, reflecting an 8% increase in AUM over this period. The hard currency MGM solutions grew to 247 million, which represents a 13% expansion. That's an increase across the board, which is very encouraging. That's not the only increase. The number of supporters have also grown. The model portfolios are approaching 200 advisors using them in their client portfolios, and there's an uptick to 586 for the fund of funds and 735 in the cash and income solutions. There has also been a stark increase on the offshore front, with the feeder funds increasing to 261 and the MGM solutions increasing to 112 advisors supporting the solutions. These figures are indicative of a shift towards risk on investments as markets are showing signs of recovering globally and advisors and their clients seeking to take advantage. There is still growth in cash and income solutions, albeit less aggressive than what there was in the previous 2 to 3 years. But it remains the biggest portion of the MFP investment book in terms of AUM. Maybe it's time to start considering sweating these assets a bit more. But don't take my word for it. Let's wait to hear what the panel's view is on what they expect the asset classes to deliver, and also bear in mind that it depends on the client outcomes you are trying to solve for. I would like to, on behalf of all of us at Momentum Investments, thank you for your continued support on the platform and Houseview Solutions. Without you as our valued partners, we would not be able to celebrate these successes. Before I go, I just want to highlight a recent communication you would have received regarding the Momentum Flexible Income Fund. The Momentum Flexible Income Fund, which forms part of the Cash and Income Solutions section of the MFP Houseview, has recently been repriced. There have been some phenomenal inflows, and the fund has grown to a level that has allowed us to reduce the fee from 69 basis points to 52 basis points, which is a 17 basis point saving. This ensures we treat your and our clients fairly, and the fund remains competitively priced in the market. This change was implemented on 1 February, and all invested clients are already benefiting from this reduction. Please also be on the lookout for the updates on the transition of the platform to F&Z, which is now called Project Singular. Himne and her team are making good strides in delivering this transition, and they will keep you abreast of the progress. With this in mind, it is imperative that we focus on the digital transformation in the way you transact with us. You can expect to see more communication on the progress of the digital adoption in the channel throughout the year, and I would like to urge you to start using the available online capabilities. Now, without further ado, I would like to welcome Momentum Investments economist Sanisha Packirisamy, who will briefly touch on the shocks that hit the global economy last year and the effects it has had. With that backdrop, she will discuss the inflationary pressures in the current environment and what it means for global growth. Bringing it to our shores, Sanisha will unpack what risks the Eskom debacle poses and what the upcoming national elections in 2024 might hold in store for us. Sanisha, welcome to the stage, and I certainly look forward to, as always, your valuable insights.
Thank you, Hugo, for that amazing introduction, and hello, everyone. Aside from the effects of the COVID-19 pandemic still reverberating worldwide, a series of mutually reinforcing shocks further struck the global economy last year. The war in Ukraine reignited food and energy inflation, and higher price pressures spilled over into other areas of the consumer basket. This forced up interest rates at the fastest pace in decades. A cost of living crisis gripped many nations, worsening food insecurity in parts of Africa, Asia, and South America. Alongside economic hardship, climate-related disasters inflicted humanitarian crises and furthered economic damages. What a year! It's no wonder that against this backdrop, which analysts are referring to as the Great Reset, it will be difficult for growth in the globe to emerge strongly this year. In January, the World Bank released projections for a slowdown in global growth to 1.7% for 2023. This would leave growth at its weakest pace in nearly 3 decades, overshadowed only by the global financial crisis of 2009 and the pandemic in 2020. 8 months ago, the globe was expected to grow at 3% this year, but more aggressive monetary policy tightening, a deterioration in financial conditions, and declining confidence have led to growth downgrades by the World Bank in nearly all of the advanced economies they cover and about 2/3 of all economies in the emerging market world. A lasting impact of these economic shocks has consequently led the World Bank to downgrade growth forecasts for half of the economies globally next year. The sharpest rise in central bank rates in decades, together with no pending resolution to Russia's war in Ukraine, are likely to continue dampening growth prospects this year. You would have to go all the way back to the late 70s to experience a similarly sharp pace of interest rate tightening that we observed over the course of 2022. While at 4.75%, interest rates in the United States are at the highest rate they've been since 2007, yet a surprisingly strong jobs report in January underscores the need for continued restrictive policy. Market-implied policy rates indicate a further 80 basis points of interest rate hikes in the US to peak in the third quarter of this year, close to 5.5%. Across the Atlantic, a number of European central bank officials have intimated that markets may have been too optimistic about inflation trends, signaling more to come. Interest rates in the Eurozone have been hiked by 300 basis points so far, leaving policy rates at their highest level observed since late 2008. Markets are pricing in the end of the hiking cycle in the Eurozone in the third quarter of this year and are signaling a possible peak in interest rates of 3.75%. Central banks have tried to signal that they have more work cut out for them to truly vanquish inflation, and they have upfront stated an intention to bring inflation back down to pre-pandemic levels. However, financial market participants are just not buying it. Markets are betting that inflation will dissipate rapidly and that interest rate cuts will arrive sooner than central bank officials themselves are signaling. That level of conviction has driven a relatively buoyant start to the year in markets. The risk-off bid for the dollar has reversed, and we've seen a steep 11% depreciation in the US dollar since its peak of below parity in late September last year. Moreover, stocks and bonds have recovered strongly year to date after being torpedoed during 2022. Last year was truly an anomalous year, insofar as the traditional inverse relationship between the performance of bonds and stocks collapsed in response to decades-high inflation and a sharp rise in interest rates. This sets a big question for financial markets this year in terms of who will prove to be right. A rapid and synchronized pace of monetary policy tightening by key central banks across the globe has pulled liquidity out of markets in a reasonably short space of time, leaving economies in a more vulnerable position. Signs are becoming increasingly apparent that the aggressive pace of monetary policy tightening has started to cool demand and lessen inflation. However, the International Monetary Fund, or IMF, notes that the full impact of this tightening is unlikely to be realized in its entirety before 2024. This alludes to weaker growth prospects ahead. Central banks are finding themselves at a critical juncture. Economic prospects have weakened considerably due to tighter policy, but inflation is not quite yet under control. Global inflation averaged nearly 9% last year, but is set to decline this year. The IMF notes that global inflation likely peaked in the third quarter of 2022, with food and fuel price inflation coming off. Weakening demand and easing commodity prices, which have driven disinflation, which is positive but declining inflation across a number of economies. The World Bank shows that whereas 90% of economies were experiencing accelerating inflation in June last year, by November, only 30% of economies were in that position. Inflation has risen across a broad range of goods and services. While headline inflation is decidedly moving lower, core or underlying inflation has not yet peaked in most economies, given second-round effects from earlier shocks. Tight labor markets resulting in robust wage growth has in addition created spillover effects from that initial round of inflation. Nevertheless, contracting money supply in the United States, slowing activity due to substantial monetary tightening over the past year, and easing supply chain disruptions should eventually also lead to lower core inflation, albeit with a lag. Although shorter-dated inflation expectations reacted to higher commodity prices, longer-dated expectations have been far more stable. Inflation expectations are important for central bank decision-making and their communication strategies to the broader public, since they have a direct influence on consumption decisions and wage demands, which then in turn underpin price setting at a business level. The gap between shorter-dated and longer-dated inflation expectations reveals that households have given less weight to current inflation when formulating their long-term expectations. This also gives central banks a bit more comfort that households and financial markets have not lost faith in central banks' ability to influence inflation despite the breach in inflation targets currently. Now, this is a key shift in thinking since the 70s stagflationary episode, when central bank credibility came under significant threat. Despite the continued downtrend expected in inflation in the coming months, disinflation will still take time, and it may be a while before inflation returns back to targets. The IMF warns that headline inflation will still be above pre-pandemic levels in 82% of economies in 2024, and core inflation will exceed pre-pandemic levels in 86% of countries in 2024. As such, inflation persistence remains a key risk to the global economy to the extent that a more aggressive monetary policy response or higher interest rates for longer can have a deeper negative effect on growth. The IMF notes that positive surprises and greater economic resilience in a number of countries has led to a less negative outlook than previously. Since October, their growth outlook has brightened. However, they continue to note that even though the most adverse threats have likely abated, the balance of risks remains firmly tilted to the downside. As such, the risk of a recession in key economies remains high, with a number of key indicators flagging a rising risk of recession. The leading indicator for the United States, consumer sentiment, residential investment in real terms, services PMI, mortgage lending standards, and even the equity market at times have been at levels consistent with those experienced during a downturn in the economy. Moreover, a more deeply inverted yield curve is questioning confidence in the economy's ability to withstand additional interest rate hikes. As such, a prolonged rise in inflation poses a key risk to our global view. More aggressive interest rate tightening, relative to what is currently baked into markets, would undermine household purchasing power even further from currently weak levels. Wages have not kept pace with high inflation, resulting in the biggest loss in real income since the 70s. Since 1990, there has been a greater opening of the global economy, leading to the free flow of people, goods and services, ideas, and even capital. This period also led to China opening up to capitalism, and we also experienced the emergence of the so-called Asian tigers. These high-growth economies were fueled by exports and rapid industrialization. This period of trade liberalization ushered in lower volatility in both inflation and growth, which resulted in a higher level of macroeconomic stability. The lingering pandemic and the ongoing war in Europe has made the world experience a slowdown in the pace of globalization, or what the IMF refers to as slowbalization, which is reshaping the way in which we conduct business and trade. Regional trading blocs and friendshoring have emerged as alternatives to actively access global markets while escaping the fragility of supply chains that became evident during the pandemic. The shift to globalization feels like a regime shift, given that it has been accompanied by higher levels of volatility, a wider range in macroeconomic forecasts, and shorter and sharper cycles. However, outside of a shift in trade dynamics, a few other pillars which were instrumental in lowering volatility between 1990 and 2016 have undergone a fundamental change. This suggests that we may be returning to a regime akin to that prior to 1990, where cycles were shorter and sharper, the range of macroeconomic forecasts and outcomes were wider, and uncertainty and volatility were more elevated. Chatham House notes that unlike the 90s, the scales have tipped towards greater suspicion of globalized approaches, making it more difficult to collaborate on an international scale when dealing with global challenges such as poverty, health outcomes, and climate change. The first pillar, previously supporting a more stable regime between 1990 and 2016, has been disrupted by the emergence of more power nation-states, an increasing push for local solutions, as well as more border controls and protectionism. The collapse in the second of these pillars is related to a world with less abundant liquidity. The need to quell inflationary pressures caused central banks to pivot their view on monetary policy to a more restrictive stance, and as such, balance sheets have also been reined in. The third pillar previously rested on high single-digit growth rates out of China. However, going forward, it is reasonable to expect much slower trend growth in the Asian giant, given policy efforts to drive the economy away from export and manufacturing dependence to more consumer and services-driven output. The fourth pillar of a more stable environment has been interrupted by the global spread in political polarization. A painful increase in poverty and inequality has urged electorates to challenge the political status quo. The Carnegie Endowment for International Peace claims that political polarization is tearing at the seams of democracies around the world. They attribute more divisive societies to the rise of social media, more aggressive opposition leaders, a sharp increase in patronage and corruption, as well as growth in middle-income classes, merely highlighting those who have been left behind. These stark political divides are likely the source of the recent rise in political violence, which further stymies economic and social development. This shift in the political discourse has placed institutions essential to democracy under significant threat. The Brookings Institution claims that the rule of law and democracy are crucial to capital markets. A free market, they say, balanced by a democratically elected, transparent and capable government, together with a strong civil society, yields stable economic growth rates and greater gains in social welfare. However, with democracy under siege, autocratic alliances are promoted. This could result in a shift in global power to a more fragmented multipolar model. Competition stands out as a potential advantage of moving from a bipolar to a multipolar world order. However, this shift could, on the flip side of the coin, threaten global security, causing new government alliances to be reached, and could trigger an increased focus on military spending. This is a segue to the fifth pillar collapsing, which involves a potential end to the so-called peace dividend that resulted when the Berlin Wall collapsed in 1989. Thereafter, growth flourished as spending on defense was reallocated to other economic and social priorities. What followed was a period of above-average economic growth and lower inflation. In recent times, however, a series of mutually reinforcing political shocks have hit the global economy in a very short space of time. More recently, Russia's aggression against Ukraine and the West more broadly have led to countries like the US to shift their focus towards rebuilding defense capabilities. As such, we believe this will result in a higher level of geopolitical risk going forward. The Economist Intelligence Unit warns that the war in Ukraine could extend to a downside risk scenario if conflict arises between Russia and bordering NATO member states. In a worst-case scenario, potentially involving nuclear warfare, major cities in the US could also be impacted. Although the probability of the scenario is deemed to be relatively low, it would have an outsized negative impact on the world economy. Other areas of the globe are also subject to geopolitical conflict. The unpredictability of the North Korean regime remains concerning, while Iran engaging in nuclear development enrichment raises the risk of a military confrontation between itself and the United States. Strained China-Taiwan relations pose yet another geopolitical danger to the globe. Conflict between China and Taiwan could lead to the US convincing other democracies to place inhibiting trade restrictions on trade, technology, and finance in China. A further deterioration in ties between the West and China could cause further decoupling pressures and induce supply chain disruptions. Global semiconductor supply chains, where the United States' efforts have recently been focused, have significant choke points in their supply chain that threaten to make microchips an even bigger geopolitical issue. Even though the US still holds a significant technological edge over China, Democrats and Republicans in the US both broadly agree that Chinese advances in digital technology threaten America's national security. Recent moves by America to prevent companies in the US from supplying Chinese chip makers with equipment that can produce advanced chips unless they have a license are quite damaging for this nascent but mushrooming industry in China. This move is likely to slow China's progress on weaning themselves off advanced chips manufactured elsewhere in the world. In this new old regime of higher volatility and less macroeconomic stability, the globe remains vulnerable to shocks, and as such, the IMF has urged policymakers to rebuild fiscal, monetary, and financial buffers to restore a higher level of economic resilience. This is particularly true for emerging markets, which have endured the spillover effects of rapid monetary policy tightening in developed markets, which triggered capital outflows and currency depreciations. With global financing conditions having tightened sharply, debt sustainability risks have increased for frontier markets in particular. Debt levels have spiraled higher and pushed up debt servicing costs. This has further reduced fiscal space and raised sovereign credit risks. A growing number of governments in less developed countries are now seeking out bilateral and multilateral support. Vulnerability remains high in tourism-dependent developing markets, where arrivals have not fully recovered since the pandemic. Developing economies that experience more frequent climate-related disasters are also expected to remain on the back foot. The World Bank shows that climate risks are rising and weigh heavily on small, vulnerable states, which have to safeguard agriculture and make infrastructure more resilient. In our view, rising geopolitical fragmentation poses a threat to achieving climate change goals, given the level of global cooperation required to accelerate the clean energy transition. Moreover, the Russia-Ukrainian war temporarily set back efforts to transition away from coal in both advanced and emerging economies. Despite major shifts in economic and political trends, these downside risks to the baseline view could be balanced out by some potential upside surprises that could deliver a better than expected outcome this year. Russian President Vladimir Putin's plans to squeeze Europe by weaponizing energy were dampened by milder winter conditions in Europe. This doused fears of a gas shortage and lowered the need to enforce demand management. While tighter monetary policy and slower global growth will weigh on European economic outcomes this year, a record warm winter so far has softened the bear case scenario for this region. Similarly, a faster pivot towards a relaxation in COVID-19 regulations in China has paved the way for a faster than expected recovery. Pressured conditions in the real estate market and health consequences of low immunity levels, as well as insufficient health provisions, pose risks to the expected rebound in China. However, pent-up demand could drive a stronger recovery. The IMF notes that for each additional percentage point growth in the Chinese economy, a 0.3% uplift is provided to growth in the remainder of the globe. A slowing global economy provides further headwinds in our own local environment. South Africa faces a tough situation with load shedding, anemic growth, unemployment, poverty, and widespread corruption. In addressing load shedding, government recently announced a number of interventions to alleviate the short-term crunch in energy supply. A new position in the presidency, focusing on the country's electricity crisis response, could fast-track the implementation of government's energy action plan through more decisive action. Meanwhile, the procurement of emergency power can lessen the intensity of load shedding and the negative effects on growth in the near term. Nevertheless, insufficient energy remains the #1 downside risk to growth. This is likely to keep trade growth below 2%. Load shedding has increased the cost of operation for businesses and as such weighs negatively on expected revenue collections for the next fiscal year. Risks to fiscal consolidation are also coming through from the expenditure side. Financial demands from other state entities, a more permanent form of the social relief of distress grant, and risks to a higher than expected wage bill to reflect cost of living increases all add to expenditure pressures in the medium term. Allegations and incidences of state capture, corruption, and the mismanagement of public funds have tarnished the attractiveness of SA as an investable destination. Public trust in state institutions is unlikely to change unless the fight against corruption gathers momentum. Those who are guilty of wrongdoing are apprehended, and there are tangible indications of an improvement in the performance of crime-combating agencies. Given continued electricity woes, elevated criminal activity, a backdrop of slowing global growth, and noise around the Phala issue, levels of support are expected to drop for the African National Congress in the upcoming 2024 national elections. There is an increasing likelihood of a coalition government having to form in South Africa at a national level. According to research by the Social Research Foundation, support for the ruling party has likely fallen to below 50% on a countrywide level. This has the potential to further slow progress on developing a more comprehensive social compact with all economic players to reinvigorate a socio-economic recovery. Risks abound from persistent inflation, tighter monetary policy, geopolitical instability, and lower growth, making this another challenging year for investors. After an extensive period of generous liquidity and macroeconomic stability, investors are now faced with a considerably higher risk environment than before. Market timing will become increasingly challenging against a backdrop of higher volatility. As such, we would urge investors to not make any unnecessary changes to portfolios which could scupper their ability of building long-term wealth. In our view, successful long-term investing ultimately requires sticking to a well-diversified and sound investment strategy and avoiding reacting to short-term market noise. Thank you for your time.
Thanks for those insights, Sanisha. It is clear that uncertainty in the markets may still persist for a while longer and give investors a few challenges. The key message for me from an advice perspective is to ensure your client portfolios are correctly positioned to reach their outcomes and stick to the plan. Avoid making any knee-jerk reactions based on the noise in the market, which has proven time and again to have a negative effect on long-term returns. Next up is a panel discussion moderated by Momentum Investments' Head of Behavioral Finance, Paul Nixon. The panel will discuss the investment environment in 2022 and the prospects for the year ahead, as well as how they have been navigating this in the MFP Houseview solutions. They will also give you some insights on fixed income and global investments. Over to you, Paul.
Thank you, Hugo. Good day, everyone. I'm Paul Nixon, Head of Behavioral Finance in Momentum Investments. With me are Ian Scott, Head of Fixed Income at Momentum Investments. He's on my far left. Then it's Dean D'Souza, who is the Portfolio Manager of the MFP Focus Model Portfolios. And next to him is Ronnie Bodman, our Focus Fund of Funds Fund Manager. And last but not least, we have Richard Stutley from Momentum Global Investment Management, who is dialing in from London. Now, it's no easy task these days to be making investment calls as uncertainty becomes more and more certain. Sky's political editor, Alan McGuinness, tweeted last year that my son has lived through 4 chancellors, 3 home secretaries, 2 prime ministers, and 2 monarchs. He's 4 months old. But it wasn't all doom and gloom. 2023 started with a bang in the local stock markets and with supercomputing giants OpenAI releasing an AI chatbot trained to understand exactly what human beings mean when they ask any question. ChatGPT has enthralled and amazed the world. Now, you can ask ChatGPT anything. And I asked it for a limerick or humorous poem to sum up what's happened in 2022, and this is what I got. In 2022, the markets were rough. Investors found it all rather tough. The bears took control and prices did roll, leaving portfolios not looking so buff. Richard, I'm going to start off with you. Can you maybe recap full year returns for us for 2022?
Yeah, sure. 2022 was clearly an extremely weak year for all of equities, bonds, currencies, other than the dollar. Most emerging markets, with the exception of Brazil, and thankfully also South Africa, doing well. Property weak, many metals down, that list goes on and on, I'm afraid. Now, while painful, these periods do come along from time to time, and you see if you look back at history, that they don't tend to last very long, thankfully. Point in case, between October last year and now into January, the MFP Global Houseview funds gained between 13 and 17% in dollar terms as markets rebounded. Looking at last year, the funds outperformed traditional equity bond benchmarks, as we would expect. So while down, the cautious fund nonetheless outperformed by 1.2%, managed by just less than 1%, and growth by 1%. Key contributors driving that outperformance were underweight to equities and bonds, and overweight allocations to gold, infrastructure companies, and cash. Versus peers, which is the other key performance area we need to look at. Peers who invest exclusively in US dollars and dollar assets got a real leg up last year, thanks to the dollar appreciating against nearly all other currencies. Now that has started to reverse since peaking at the end of September. The dollar is down by around 9% to the end of January. As you know, we prefer to invest in a mix of currencies for the simple reason that no currency, and that includes the dollar, is a one-way bet. All 3 funds were close to the median in their peer groups last year. In other words, an average outcome. If you look over longer periods, you'll see that we tend to do a bit better than the majority of peers. So overall, it was a reasonable year for the funds in tough market conditions, and we've seen a very decent rebound post-October.
Moving closer to home, 2022 has been a difficult year for markets and most asset classes in general. So Ronnie, the Focus Fund of Funds, can you maybe take us through the how the Focus Fund of Funds has performed last year and also focus in a bit on the latter part of the year?
Yeah, certainly, Paul. I mean, as you mentioned, 22 has been a particularly difficult year for markets. Thankfully, we went into the quarter with a bit of a risk-off stance into quarter four. However, the fund of funds participated very well in the market recovery we saw during the beginning of the quarter. So the focus range of funds delivered performance between 5% and 8% for the quarter. And this is well in line with the fund's strategic benchmarks over that same period. Also from a peer relative perspective, it is second quartile relative to the various ASISA SA multi-asset class peer groups. So despite the very strong quarter we had in the last quarter of the year, for the first 3 quarters of the year, both local and global asset classes, in fact, were strongly negative. The rand, however, weakened 6.1% against the dollar during this period, and that had the effect of actually softening some of these strong negative global equity and global bond returns for the year. So this all helped the funds to end the full year just shy of a positive return, which overall is not an entirely a bad outcome given the year we've had. So far, January has been a very strong month as well, and February has proved a little bit more muted. However, where we sit now, the funds are still in positive single-digit territory for the year to date.
Dean, now, I mean, you can add anything to what Ronnie's views are on the markets, but then if you can also just add some of the, some performance review of the MFP model portfolios.
Sure, thanks, Paul. So, I mean, obviously, Ronnie and I manage those portfolios, fairly closely together. So the performance in the quarter, very similar to the fund of funds, also up about sort of 5 to 8.5%. We did go into the quarter with a little bit more property and equity, which obviously would have helped us. But again, over the full year period, that slightly higher property would have counted against us. We've also benefited from this massive amount of exuberance in markets following, the positive surprise in inflation in November last year, and I suppose the very necessary returns, because had we not seen this Q4 rally and even into January now, I think portfolio returns would have been deeply negative into 2022. I think what is encouraging on the portfolios is that I think from a tactical perspective we were positioned on the right side of it. So I mean, going into 2022, we did feel that global markets were quite expensive, and so for the most part of the year we had a preference for local asset classes, and so that continued throughout the year. And of course, with the outperformance of local asset classes relative to the strategic benchmarks, we've obviously added some decent alpha. I think one thing that did help for us, very positively in the year was that we did up some of our global cash, late into 2021, and of course, with the sharp weakening in the rand over the year, global cash actually turned out to be the top performing asset class across the board. So that more defensive positioning in global cash did help, and it did give us some diversification when we did see turmoil in the local markets.
So I mean, I guess in essence, some light at the end of the tunnel. Light is a scarce resource in South Africa. But on that note, Ian, I'm going to come to you now on the fixed income markets. So I think perhaps maybe the first question is, how do you see this dislocation between the US Treasury and the Fed, and how will it be resolved this year?
Sure. Isn't that the trillion-dollar question? Talking about a Fed with an $8 trillion balance sheet, there's this dislocation between how the Fed keeps on focusing very narrowly on inflation. And remember, the risk of policy error is quite high in the world at the moment, where the Fed was so stuck in this disinflationary idea and mindset that they had in 2021 that they didn't want to hike interest rates when inflation was actually rising quite rapidly. Then in 2022, they went overzealous in terms of inflation, and they keep on hiking. And the bond market is actually signaling that, look, we're getting to a point where you're getting closer to the end of the rate hiking cycle. But every week, basically, we hear the Fed governors coming out saying, look, more hikes, we're not going to stop. Inflation is not going to come down, but inflation always works with a lag. And the issue at the moment is that the bond market is actually telling the Fed that, look, you guys have to be careful, because two things happened on the US curve that's quite important. And we always talk about the 2-year, 10-year inversion. So just the 2-year rate is obviously trading higher than the 10-year rate, substantially so. Is two things. It's actually the duration of the inversion, because it's probably now more like 8 or 9 months that the curve has gone inverted. Now that's quite large in terms of time, because yield curves don't go inverted for long periods of time. And secondly, is actually the quantum of the inversion. You know, at 80 basis points, that's quite steep, telling you the bond market is a lot more concerned than what the Fed is around growth. So, I mean, we're already starting to see those canaries in the coal mine in terms of the US housing market, the auto market, credit card spend, credit card debt going up. So there's definitely canaries in the coal mine telling the Fed, look, you guys are in the rate hiking cycle, but you probably have to get closer to the end, because there are signals in the economy that, look, there could be trouble down the line. How does the dislocation play out? Well, you know, as much as people always say, don't bet against the Fed, I would say to the Fed, don't bet against the bond market, because at some point it could come and hurt you. What we saw in that piece around the UK, remember that that change of prime ministers was driven by the bond market. So once the bond market revolts, the central bank will relent, right? And then the Fed will have to take the foot definitely off the brake, and even put some stimulus back into the market. So that's where it ends. It doesn't end with the bond market, it ends with the Fed.
So, I mean, the world sneezes, South Africa catches a cold. I mean, what are these kind of actions by central banks? You know, what effect does that have on emerging markets like South Africa?
Massive. So 2021 and 2022 was all about the Fed, right? Especially, you know, how hawkish does the Fed get? Because that's a risk of environment for emerging markets. The rand comes under, all emerging markets come under pressure. All emerging market bonds come under pressure. And that's exactly what happened in 2022. Obviously, we've seen a little bit of a reverse towards the latter part of 2022, when the Fed actually signaled that the rate hiking cycle is going to slow. Suddenly, risk assets, you know, became flavor of the month again. There was yield in great real yields in some emerging markets. So example would be South Africa and Brazil. Our bond yields are quite above where the inflation rates are even today. It's going to be more so this year, because you're probably going to find that inflation unwinds this year in most places in the globe, in developed markets as well. But what you would probably find this year is that not all central banks are going to hike anymore. In fact, you're probably going to get that the Fed gets to the end of the rate hiking cycle, the SARB gets to the end of the rate hiking cycle, maybe the Bank of Canada will end, but other central banks will probably have to go further. I mean, the ECB was so late to the party, they will keep on hiking, they've got no choice. The Bank of England, they've got an inflation problem in the UK, so the Bank of England will keep on hiking. Other central banks will start beating back some of the brakes. What it will mean is that when there's real yield opportunities in emerging markets, that they actually could be on the buy list. Unfortunately for South Africa, we're not that great on the buy list due to our own idiosyncratic factors, and we don't have to delve into that. But other emerging markets might actually come into flavor. So I think EM is definitely back onto the buy radar in various asset classes, not necessarily always just in fixed income, but surely there's going to be places in EM equities and EM property that does look interesting.
So we're not going to be paying any less on our home loans anytime soon, is what you're saying?
Well, let's see. I'm positive.
Okay. All right. So we've spoken about 2022 a little. We've spoken about 2023. So let's maybe get the crystal ball out for a few minutes. Go back to you, Richard, and talk about the future and what we can expect for 2023.
Yeah, sure. So starting with the macro, which is always important to keep an eye on. The falls we saw last year were primarily a function of rising interest rates and indeed uncertainty over how high they would need to go in order to get a grip on some pretty high inflation numbers. Now, here we are at the start of 2023. Thankfully, we've got a better understanding of inflation dynamics because we can see the impact rising interest rates are having on key sectors like the housing market in the US. And this gives us greater confidence that interest rates don't need to go much higher than they are today, speaking towards the end of February. We don't expect interest rates to fall quite as fast or indeed as far as some other investors seem to think. And it's interesting actually to see those other investors and treasury prices slowly starting to come round to our way of thinking in recent weeks, i.e. interest rate expectations have actually been going up. Now, as always, there are risks out there. I'm afraid Putin hasn't gone away. We're mindful, of course, that monetary policy works with a lag. Think about homeowners on short-term fixed-rate mortgage deal, which start to roll off into higher interest rate loans. And hence, we've not seen the full extent of the squeeze on consumers caused by this hiking cycle. But with household and corporate finances in pretty good shape in the key global economies, we don't think we're in for a really tough economic outcome this year of the kind that we need to get really worried about. And there I'm talking about a kind of 08 style outcome with a 5% decline in global GDP. Thankfully, we don't think we're in for that, even if we do see a recession. Now, what's more important to us, remembering it's very hard to predict these macro variables, you just have to look at the mess central banks like the Fed have got themselves in with their forecasting in recent years. What's more important than that is prices and yields. And we started this year with pretty attractive yields, a risk-free rate of around 1.2%, 10-year treasuries paying upwards of 3.5%, right now nearly 4%. Corporate bonds then paying between 5 and 7%, depending on credit quality, and parts of the equity markets like UK equities yielding 10%. So all of that looks interesting. And alongside that, we've got other areas that look very significantly oversold. Listed private equity down 85% peak to trough. Chinese real estate down some 75%. Chinese equities 45% behind the US over 18 months. So these are cheap areas in our view. We want to profit from them, and we therefore hold them in the funds. So overall, 2023 prospects we think look pretty good, particularly on a longer term view.
All right, so Ronnie and Dean, let's turn our attention to the multi-asset model portfolios once more. So Ronnie, maybe start with you. How are we positioned for the year ahead in multi-asset, in the multi-asset fund of funds, should I say?
Yeah, Paul, I mean, sharing a lot of the sentiments that Ian and Richard have also spoken to, from our perspective, we think, broadly speaking, in terms of macro, we think it's going to be a lower growth environment for 2023 globally. We do see inflation cooling, but not necessarily retreating as fast as some have expected, so essentially a little bit stickier. We therefore think, the Feds and various central banks will effectively cool their rate hiking cycle, but they won't necessarily pivot and cut rates as much as expected during 2023. And then, of course, from a geopolitical perspective, the situation in Ukraine is not really easing off. And obviously, in the back of our heads, we also have sort of the China-Taiwan situation to think about. So with all that being said, I think it's prudent for us to continue with a risk-off stance going into 2023. We know Regulation 28 has made it more accessible for local funds to access global assets, but we haven't been drastically adding to our global exposures at these levels. The rand is looking very undervalued at this point in time, so it's not necessarily a great time to externalize assets. This has been a strategy that we also stuck with during 2022, and it has in fact been very positive for the portfolios, but we remain sort of on the lookout for opportunities going forward. Global bonds are definitely looking more attractive, and we've been adding to that since Q4, primarily by rotating out of global equity. And then on the local front, despite all the challenges we have in the local economy, we do think, and we remain of the view that local equities look attractive from a valuation perspective, so both relative to their history and also relative to some of their peers. So we've been sticking closer to our strategic asset allocation level from our overall allocation to that asset class. Local bonds keep looking attractive, both on a sort of real and a nominal basis, relative to cash and RLB as well. So we overweight to local bonds. And then lastly, what I will add is the Chinese consumer is looking very strong at this point in time. And we know with China coming out of lockdown after nearly 3 years, we think that should provide a strong underpin for the emerging market sector. And therefore, we are overweight to that asset class as we stand right now.
Cool. Then again, once again, to add on to what Ronnie's saying, just with the view of the MFP model portfolios.
Yes, I think broadly very similar thinking in the portfolios. I think the big concerning factor for us is obviously we've seen equities in the global space fall quite far, as Richard had obviously recapped. But at this point in time, considering the macro variables that everyone has discussed, we just think that global equities remain priced for this Goldilocks scenario of a not so hard landing in the US, with earnings still holding up very strong. And we just think that any change to any underlying variables and those valuations then come again under pressure. And so we've been very happy to remain underweight global equities, but of course each portfolio has their own growth assets from a strategic perspective, and so we're making up for the underweight in global equity by remaining a little bit overweight on the local equity side. And as Ronnie mentioned, a lot of that is just driven by valuations, both relative to the global space as well as just relative to our own history. I mean, we are exceptionally cheap, and despite all the tough news that is the idiosyncratic risks that Ian had mentioned in South Africa, we still think the cheap valuation can protect you from that environment, especially when you consider that a large part of the operating performance on our market is actually generated outside of South Africa's borders. And so we don't need to see a very strong South African growth environment to see our local market rally. We too have added to global bonds very early in this year. So middle of January, we just felt that the exuberance in markets was perhaps overdone. And so we took that opportunity to trim a little bit of that overweight to equities, bank some of those profits, and then just beef up the defense in global bonds. Global bonds tends to do quite well in a risk-off environment. And given the risks on the horizon, we just think global bonds this year should behave a bit more normally and provide that defense to markets in a risk-off environment now that yields are closer to that 3.5% to 4% mark, as opposed to last year when bond yields were just in expensive territory and we lost out on that defense. More recently, with the rand blowing out, we have somewhat trimmed our sort of global cash exposures, just thinking that the rand at these elevated levels just seems overdone for us. So just bringing some of those global assets back just to protect from any rand strength from this point.
So cautiously optimistic, perhaps.
Yeah, to say the least. Yeah.
Ian, you know what the question is going to be. Prospects for the fixed income investor for 2023.
Yeah, so I think our colleagues have said it already, that South African fixed income screen very attractive. If you think that inflation probably around 5.5 this year, I mean, cash sits around 8.5. So I mean, getting 3% real on cash, that's really attractive. Nominal bonds still the most attractive fixed income class in South Africa. With the curve in South Africa is still very steep. If you think that the front end sits around 8% and the long end probably around 11.5. So those 5-6% real yields still very attractive. But yeah, I also want to get on the global story that it's not particularly in our view global bonds that's attractive. It's US bonds, right? Because at this point in time, I would not buy European bonds. I would not buy UK gilts because of the interest rate profiles that could still change. As I said, those central banks are still going to hike. But US bonds, very attractive in my point of view. 2 years sitting at 4.3%. Your 10 years sitting at around 3.9%. I would be a buyer of US treasuries because the Fed is probably going to get inflation down to about 2.5 to 3% this year. So you are going to see real yields at some point in the US. It is a bit of a protection strategy against if there's going to be a hard landing somewhere in the US. We don't know. But I think at around 4% real yields, US bonds does make sense. But our preferred strategy is definitely South African nominal bonds. And we're also finding good opportunities in dollar credit at this point in time. We've seen US spreads move out a lot more than, for example, European credit spreads. So we are finding opportunities in offshore credit markets as well. So I think there's more assets that we can allocate to this time round or this time of year than, let's say, previous 2 or 3 years in fixed income space.
Ronnie, what changes have you made in the focus fund of funds, given your views?
Yeah, Paul. In terms of the Focus Fund of Funds underlying mandates, we did make 2 changes to the funds during the fourth quarter. Now, the first one was the inclusion of the Momentum Future Trends Fund. Now, this fund is there to provide our clients with more direct exposure to these big thematic themes that will be evolving over the next 5 to 15 years. The fund gains this exposure by having 6 mega trends included in the construct of the fund, such as climate change, technological advancement, changing demographics, etc. These may sound quite abstract, but they are in fact real. If we just think about robotics and AI as one example, you've spoken about ChatGPT, so that's the kind of technology that we actually have exposure to in that fund. It serves as a diversifier to our global equity allocation in the fund, and it still targets the same MSCI ACWI as a benchmark index. Now, currently the exposure is still small at less than 1.5%, but we are looking to add to this as more opportunities do present themselves. Secondly, we did make a change from our very actively managed Momentum Global Equity Fund. We have included the Momentum Global Sustainable Equity Fund in its place. The fund is also very actively managed. It still has exposure to the value, quality, and growth styles. The fund still targets the MSCI World or Developed Market Equity Index as its index benchmark. However, it does so with slightly lower volatility, and it also does so at a slightly lower price point. The fund is also an approved ESG fund in terms of European regulation, and it aims to achieve a lower environmental footprint, roughly 20% lower than the benchmark index that it tracks. And then lastly, just from a practical perspective, it's also going a long way in terms of the alignment between the Momentum Focus Fund of Funds and the Momentum MFP model portfolios.
So Dean, on that note, if you can come in and maybe give us some insights into the changes that you've made in the model portfolios as well.
Sure. So, look, as Ronnie had mentioned, we try to do a lot to keep the funds very much, aligned from underlying structure perspective, just to make it easier for advisors, to when you're picking between solutions, pick on the merits of the vehicle rather than the merits of the investment solution, because we try to keep these quite aligned in line with the Houseview's philosophies. In the model portfolios, we do just need to appreciate that given that there are different vehicles, there are some different operational constraints. So we are in the process of including the Sustainable Equity Feeder Fund, but unfortunately that feeder fund has not been made available yet on the platforms. And so as soon as that fund is made available, we too will be transitioning into the Sustainable Equity Feeder Fund. And it's for the exact same reasons as Ronnie mentioned, the lower price point, less volatility, but very much close to benchmark or even better than benchmark performance. The Future Trends Fund is also, on the horizon for us, given my comments earlier around, our positioning around global equity and our bit more cautious approach. We've been, slightly behind on that, just given our views on global equity, but the themes are there and we know that you can benefit from them over the longer term. So the intention is, in the sort of near future, once the views on global equity maybe look a bit more attractive, to start incorporating it into the portfolios to give clients access to those mega themes. And maybe just one point around the mandate changes. I think what is important, is when we're considering these mandates or when clients are looking at their performances, it becomes very easy to potentially isolate the performance of a single underlying fund. And then compare that to their respective benchmarks and assess whether it's doing well or not. But I think it is important to remember that when we construct these portfolios, very seldomly are these mandates used in isolation. Very often they are used alongside other mandates. And so, for example, while the Future Trends Fund might have periods of outperformance, we will use it alongside something like sustainable equity to dampen the risk, and so that collectively we still get a more stable performance profile for clients while still getting them access to these different themes or these more unique styles.
So Richard, the last word is yours. Is it time for, perhaps a difficult question, but is it time for investors to be taking more risk in the global part of their portfolios?
Yeah, look, it's a good question. Pretty much all major asset classes look more attractive today. I was just mentioned, I've been through some of those yields on offer. We're allocated to those areas, but we are staying relatively cautious in other parts of the funds for the time being. And you can see that in our underweight allocation to equities at the moment. As I mentioned a moment ago, we want to see what opportunities are created by rising interest rate expectations. That's been going on in the last couple of weeks, as I say. Clearly, they make government bonds more attractive. Key question is, are we going to see a pullback for equities after a 20% run-up there or thereabouts since the end of October? With interest rates and inflation like to stay key themes at the start of this year, you won't be surprised to see real assets like infrastructure and property still playing a role in portfolios. Plus, we've got some gold, plenty of short maturity bonds, which have low sensitivity to those rising interest rates, and also some cash. So overall, we are constructive, as I said in my previous answer, we're constructive on a longer term view. There are plenty of really attractively priced assets in the funds, we think, but as I say, we are staying cautious in the short term rather than looking to take on more risk just yet.
Thank you, Richard. Well, I mean, that's about all we've got time for today. Before I go, maybe a quick closing note to summarize investor behavior for 2022. The Momentum Investments 2022 Sci-Fi report showed that many investors in unit trusts and living annuities are still continuing to behave or try and behave like fund or portfolio managers. The sell-off in risky assets on the securities market was almost mirrored by investor switching activity, de-risking their portfolios and moving to the cash side of the risk spectrum, trying to avoid the turbulence. Investors and their advisors need to delegate this activity to the portfolio managers that are with us today. It's their day-to-day job, rather, to ensure that any market turbulence is viewed in the context of the long-term investment objective. The Sci-Fi report examined switching data until October last year, when the FTSE JSE All-Share Index was at about 65,000 points. Soon afterwards, markets were breaking records, leaving the same investors once again to watch from the sidelines. Trying to time re-entry into markets almost always results in a behavior tax. To close off, I asked ChatGPT to write another limerick about 2023 market sentiment and the investor behavior tax, and this is what I got. The markets of 2023, oh my, may cause some investors to sigh, but those who stay steady and don't sell in a frenzy will avoid the behavior tax. Goodbye.
Thank you, Paul and panel, for your valuable insights. It's great to have some positive news on the returns front. I would now like to hand over to Francois de Revel, who will sum up today's conversation and tie it back to the MFP advice process.
Thank you, Hugo. Good afternoon to everyone. My name is Francois de Revel, Channel Director at MFP. I look after our franchise partners. Our speakers have reflected on the past quarter and shared their views and assessments regarding prevailing market conditions. 2022 was almost all about containing inflation. We believe that the main themes for 2023 will be about supporting economic growth. Whilst the year started on a good note with a positive inflation surprise from the South African economy, the reopening of the Chinese economy, and the JSE All-Share Index exceeding 80,000 points for the first time ever, other factors such as persistent load shedding, uncertainty around the Fed's hawkish undertone, and a looming US recession indicate that we are not yet out of the woods. In the quest for economic growth locally and globally, understanding how market and economic events shape the world that we and our clients live in, with the aim to retire at some stage is important, but it is perhaps even more crucial to understand how best to incorporate the knowledge gained from today's speakers in your advice process. As a personal disclaimer, before I mention the next sentence, I acknowledge that MFP boasts a number of top investment advisors. Unfortunately, this is limited. I cannot say that this applies to our entire sales force. And it is for this reason that I personally believe that these insights, together with the MFP Houseview, will enable all of MFP planners to be in a better position to navigate the uncertainty of capital markets, as well as enlighten your clients in terms of their financial well-being. And this, while affording you confidence and security that these solutions will stand any scrutiny. First and foremost, clients require a more diversified, holistic approach. Research done by Vanguard, one of the largest providers of unit trusts in the world, with about 7 trillion in global asset managements, show that clients' requirements from financial advisors have moved beyond asset allocation and investment returns. Illustrated here is a high-level summary of the value add of different wealth management activities, which together may be deemed to be best practices. The numbers on the far right show the value add to clients. According to study, advisors may add up to 3% positive returns to client portfolios. Interestingly, the biggest value add is from behavioral coaching, which can account for up to 2% of the total value add. The contribution from asset allocation of fund picking is negligible in comparison. Taking a holistic approach to financial advice allows you to add meaningful and quantifiable value to your client. Looking back, our returns for the quarter ending 31 December were very encouraging and illustrate two things: how quickly the market can change, and the importance of staying invested during times of increased market volatility. That was, by the way, part of our last Outcome Matters, if you recall. The partnership between us, the advisor as financial coach, and Momentum Investment as a solution provider creates efficiencies and allows us to tackle both of these aspects, with each party focusing on their respective strengths. The team managing the MFP model portfolios, the funds of funds, and the rest of the Houseview solutions are experts at fund picking and investment management. The solutions are made to cater for your client's diverse investment objective across various risk appetites, including spanning the different investment horizons to navigate the changing market conditions. With the investment decision-making activities, such as asset allocation and fund picking, looked after by your Momentum or MFP partner, you are enabled to spend more time with your clients and provide behavioral coaching that will help them build financial wealth instead of eroding it through unnecessary switching at inopportune times. Our behavioral finance team has previously shared the figures on the adverse impact of abandoning the original plan. If your clients' goals have not changed, it is important that you help them remain disciplined and encourage them to stick to the original plan and ultimately reap the rewards of staying invested. While our Houseview partners at Momentum Investment work hard to optimize their solutions, it increases your capacity to have the right conversation regarding financial planning and your invaluable guidance. Your true value lies in the ability to build trust, confidence, and financial peace of mind for your clients. Partnering with a provider whose solutions are constructed with your clients in mind, and hopefully by using insights gathered today, will help anticipate your clients' needs and help them achieve their investment goals. From my side, I thank you once again for your attendance. Have a great day.
Thank you, Francois. Last but not least, I would like to welcome MFP CEO Dani van der Berg to close out the event for us.
Thank you, Hugo. And thanks again for the amazing, insightful and factual presentation, investments. I mean, we just have an amazing partnership with you, and your diligence in terms of how you come to the party to give us all the facts and all the insights so that we can actually go to our clients and put everything in perspective. Things seems to be actually more positive at the moment in the outlook, and let's use this opportunity with the amazing facts to go back to our clients and actually put everything in perspective We need hope. And factually, we have hope as well now. So let's just go out there and get our clients, to either invest, for those who are too scared to invest at this point in time, or for those giving them feedback that there's hope in terms of what things will actually do for them in future. And this is the only thing we can give you, is actually facts with hope, so that we can actually continue to focus on our investment business. And then to you as advisors, we need to thank you as well. I mean, it clearly shows that you have the confidence in our abilities as Momentum Investments to give your clients the best investment options. And therefore, I mean, it's encouraging to see that the support of in-house funds are now almost 70% on new business. Thank you very much for that, and best of luck in actually going back to your clients or to new clients, using all the facts and giving them hope that there is real hope. Thank you very much, everyone.
From my side, thank you for attending today's MFP Outcome Matters. I trust that you have found the content not only interesting, but also insightful, and that you leave here today with valuable information to discuss with your clients. Just a reminder to watch the full session and add your ID number to the CPD section so we can verify your attendance. Our event platform will remain open until the end of April for you to still view this event and still receive your CPD points. Until next time, goodbye.